Hey everyone, welcome to a product review at Finominal. My name is Kaushik, I'm the lead engineer at Finominal. Today we are going to look at the HDFC Defense Fund. It's been trading since June of 2023. It has an AUM of about 3,600 crores and it is a very high expense ratio of 0.85%. Like always, let's start by comparing this HDFC Defense Fund with a benchmark to understand more about its outperformance. So as you can see here, it has outperformed Nifty 50 by 157%. That's very impressive. So even in this chart, you can see the same thing we have summarized in the table, right? You can clearly see the outperformance probably since its inception from 2023. If you go to alpha attribution, even here you can see the outperformance, right? In 2023, again it has outperformed Nifty 50 by 35%, and also till now it has outperformed the Nifty 50 index. The defense fund has outperformed the Nifty 50 index by 77%. So everything seems to be good about this fund, right? The returns are impressive, the outperformance is there. I think this is where I want to draw your attention to this chart, where we show the fund's abnormal positive performance compared to its benchmark. The red color region here shows the abnormal positive performance of the HDFC Defense Fund compared to its benchmark. The way we defined is as follows. When the fund's 12-month return is 2 standard deviations above the return of the benchmark, we call this as abnormal positive performance. But all you need to know is it has done extremely well compared to a benchmark. So you might think that, okay, this is great, right? A fund doing really well compared to a benchmark, it's a good thing, right? Not really. I'll tell you why. When investors notice these kinds of abnormal positive returns, they often perceive these as indicators of high performing assets. This perception drives them to invest in these kinds of funds or assets, and they expect the same to capture the similar gains. This entire journey is called performance chasing, where an investor looks at the past performance as the only indicator to choose a fund and invest in the fund, and the investor expects the same going into the future. What's the issue with this? The issue is that time and time again it has been proven that performance chasing often leads to poor returns. Even in one of our recent research papers, we have proven that chasing the performance using the past performance leads to poor returns 2, 3, 5 years into your investment journey. This is what the chart summarizes here, where here you can see the conclusion, right? Funds with abnormal positive returns outperformed slightly over the next year, which is this point. So you can just notice the red color bars here, but underperformed in the years thereafter. So if you notice just the red color, over the next 1 year, for example 1 year from now, it would have outperformed the market by 0.1%, but in 2 years, 3 years and 5 years down the line, it would underperform the market. So I think that sums up the performance chasing aspect of this fund, and I think we have learned something about how to choose or measuring the performance chasing of a fund. Now let's move on to the concentration of the HDFC Defense Fund, right? So I think it's pretty obvious that it's a equity fund. Here you can see it's a all in all equities fund, but let's go into the holdings, which is much more interesting here. In the summary, we have said here that the fund has 21 holdings. So Here in this chart, in this table, we show the top 10 stocks. The top 10 stocks sums up to 81% of the fund. This tells you about the high concentration in the top 10 stocks. So pretty much you're betting on the top 10 holdings of this fund, right? Especially if you see the top 2 holdings here, you're allocating 20% to Hindustan Aeronautics and about 18%, 17% to Bharat Electronics, right? I think this is expected in a sectoral thematic fund where you buy or you allocate money to this fund for its concentration, right? So the concentration here is the defense aspect of it. So let's move on to the next topic, which is, I just like seeing the month over month returns of the fund. Here in 2024, you can see in all the months till now, it has outperformed Nifty 50, especially in June of this month, which is last month. It has generated a return of 27%. Generating a return of 27% in a month is just such a huge number. So it's a good thing that it has outperformed the benchmark throughout this year, right? So something to know about this fund about for this year. Next, let's move on to the style aspect, or to understand the style characteristics of this fund. We have come to asset comparer, where we understand how the allocation of the stocks in this fund is, right? I just love this chart because of the pure simplicity of it, and it just summarizes the entire fund in just 4 charts. So here you can see from a valuation perspective, it is expensive, it's high on valuation here, and from a market capitalization perspective, it's low on market capitalization, so it has a lot of small market cap stocks. From growth perspective, both EPS and sales, it's high on growth, it has high growth potential. And we have already seen the outperformance and the excess returns of this fund, right? So it's expected that it's high on momentum, and as any high momentum fund, it comes with volatility, right? So it's high on volatility as well. Finally, I want to draw your attention to the short history of this fund, right? So it's been trading only since June of last year, so it has a history of about 1.1 years, right? So with this small history, it's hard to understand how this fund would do in periods like COVID or in periods like financial crisis, right? Where I think that's where a fund with longer time frame always helps you to analyze a fund thoroughly, right? But with newer funds, it becomes harder to analyze those things because of the lack of history, right? I think this is where the replicated returns of this tool comes in, where we replicate the returns of the HDFC defense fund in this case using the factor exposures of this fund. So let me switch to replicated returns to see you how cool it is to go back in time without even having the data for it. So here I've chosen replicated returns. So you can see here, although the fund only has 1 year of data, you can go back as far back as 2006. So here you can see during Lehman bankruptcy, which is the financial crisis, the fund would have gone down by 80%. Whereas if you compare it to COVID, it would have gone down by 52%, right? But in both these scenarios, pretty much in all crisis periods, it has gone down really drastically compared to the benchmark, right? Here you can see there's like a 20% difference here. Here again, probably twice twice the drawdown here, right? So I think that sums up this video. What we have learned in this video is, the main takeaway from this video for me would be is the performance chasing aspect of it. We learned from this chart as well as through this research paper that performance chasing often leads to poor returns, and it shouldn't be the only data point. Like looking at the past performance shouldn't be the only data point one must consider to invest in a fund. We also looked at the concentration of this fund, where the 80% of the holdings are only in the top 10 stocks, and we touched upon the style aspect, the style characteristics of the fund, and finally we looked at the replicated returns, how you could go back in time and look at how this fund would have performed in the past. That's it for this video. Thanks a lot for watching. See you next time.